there's really one question that you need to ask whoever you're sitting across. Tell me one deal that you either made a lot of money on or lost a lot of money on. And that will give you a very clear picture what kind of risk appetite. Just last week, there was an article in the Wall Street Journal that stated there are over 430,000 households in the United States that are worth 30 million and above. And of that figure, 74,000 households are worth 100 million and above. I am pretty sure that in the next 50 years, World Series is still going to happen. NBA Finals is still going to happen. The Super Bowl is still going to happen. Sports are eternal. I don't know if Microsoft will be around in the next 50 years. A client of ours that bought the largest parking garage operator in New York City. Investors walked away making a very chunky return on their investment, returned capital back to them in less than 2 years. It doesn't take 5 to 7 years. It takes 2 years, but I need a 5x on my money. I'm not interested in 20% annual return on my investment.
Yeah.
Give me a multiple.
Welcome to the Money Signal podcast from Main Street to Wall Street, where today I am joined by a very special guest and a very dear friend of mine, Misha Vasilchikov.
Thanks for having me. It's amazing to be here after the good old days at St. Francis College almost 20 years ago.
Yeah.
Thanks for having me.
Well, it's an honor to have you. Last time I saw you was actually about 16 years ago when you were interviewing me for an internship position at a wealth management company, which for our audience, I did not get. And since then, you have honestly, I just watched your journey and you've done so well. It's beyond a pleasure to have you on the podcast today. So on this podcast, I love talking to entrepreneurs, to obviously C-suites and influencers. I mean, we have a wide variety of guests. And there's always one thing that I'm looking for, which is, what are the money signals? I say that because, as you know me from 2 decades ago, coming from Bulgaria, money was a new concept to me because financial literacy is big in Europe and Eastern Europe in the sense of basically there's less finances to manage, so it's easier and less complication. And then when you come to the States, all of a sudden you learn that there is so much you could do with your money as long as you have money. So I'd love for us to always keep our focus and attention to the money signals, whether the signals that you've seen along your journey or that you currently see in some of the investments that you're currently doing. So why don't we start off first with a proper introduction of you and who's Misha?
Sure. Let's see. So my journey to where I am today is not a typical journey. As you know, in finance, you almost have to come from the right place and go to the right school and get the right internship. And everything has to work out for you to get to the ultimate destination, which is a career in investment banking or private equity. As a class of '08, I didn't have many opportunities. And as a former collegiate athlete, I was fortunate enough to have a mentor who took me under his wing, taught me the business. We worked together for the next 10 years on and off. And in January 2020, I went off on my own to launch my own firm. And the name of the firm is MVV Capital Partners. We run our securities transactions through Finalis, which is our broker-dealer of record. And the second sleeve of the business is the asset management business, which is a fairly new one for me. And that was created in an effort to provide high net worth individuals and family offices an opportunity to participate in deals that ordinarily would be inaccessible to them, partially due to oftentimes high minimums that are required in order for investors to participate in specific deals. It's not so much the high fees on entry, which I'll get to in a moment. It's really an element of high minimums in order to participate. And so oftentimes when you're dealing with large institutional rounds, whether it's part of a minority stake in a professional sports team or a $60 million purchase of a particular asset, or a $800 million Series C round in the next AI infrastructure business, there tends to be fairly high minimums to participate, which ultimately locks people out who want to participate but may not necessarily have $5 or $10 million that they can put to work.
So the only way to do that would be to go through firms or to team up with people on some of these deals, or were they really like left out?
So a lot of this business is very much relationship driven, where if you have a good relationship with the sponsor, which ultimately is the either the lead investor or the buyer of the asset, they may give you the opportunity to participate in spite of the high minimums, or they may not if you don't have a relationship with them. Part of the issue is regulatory wise, but ultimately it comes down to having many smaller investors, which requires a lot more work, and GPs oftentimes don't want to deal with that quote unquote headache. Which results in them ultimately prioritizing bigger institutional investors that will not blink an eye writing a $25 or $50 million check. But what has been happening, especially over the last several years, is two things. One is there's actually an article in the Wall Street Journal last week that outlined in the United States there were 430,000 households that are worth 30 million and above. And just last week, there was an article in the Wall Street Journal that stated there are over 430,000 households in the United States that are worth 30 million and above. And of that figure, 74,000 households are worth 100 million and above, which means that there's a massive number of fairly wealthy people, which they don't necessarily have to be billionaires, but they're self-made millionaires, whether they're real estate developers, tech entrepreneurs, or simply an operator that has been running a warehousing business or a logistics company that generates meaningful revenue and meaningful profitability, but they're kind of stuck in the good old stocks, bonds, and ETFs, which is great to have as part of your portfolio. But over the years, you may have heard that there is a shift taking place where alternatives are becoming more than just 3% of the overall investment portfolio that is recommended.
And what are alternatives? Let's break it down. What do you mean by alternatives?
Alternatives means anything but public equities, which could mean buying into a real estate asset with an institutional fund. It could mean buying into a sports team. It could mean buying into a private company that is still private, that is in the process of raising a round of capital. Private equity tends to get bucketed into alternatives. That is what oftentimes people hear when they think about alternatives. But it could mean private credit, it could mean private equity, it could mean hedge funds, it could mean venture. So it's essentially anything but public equities is what's considered as alternatives.
Oh, wow. Thank you so much for the lesson. Maybe not getting that internship is where we are today with the question. So what are the wealthy really investing in? That's always a question I love asking because of the state of the economy at the moment. I mean, obviously, the economy is always up and down. I love watching Peter, my co-host, with his market recap videos. And today the market is up by X amount, and then the next day it's down, and we lost $2 billion in cap. What are those investments that people with wealth are making?
So there are different ways of visualizing and sort of understanding where you want to allocate. And again, there's a lot of choices to choose from. It oftentimes is really an element of your risk appetite. As they say, scary money doesn't make money. Is that the saying? Is that what they say?
I'm not sure, but I'll take that saying. I like it.
All right. The reality is, everything is about risk return, risk adjusted returns. And so if you were, 4 years ago or 3 years ago, someone said, Tsvetta, why don't you put your money in Anthropic? And you said, I have no idea what Anthropic is going to be or do. But they say, look, you can make $1 gazillion and 100 times return on your investment. You might say, great, but I can also lose all of it. And so a client of mine and a very good friend at this point had said to me, there's really one question that you need to ask whoever you're sitting across, which is, tell me one deal that you either made a lot of money on or lost a lot of money on. And that will give you a very clear picture what kind of risk appetite they might have. And so someone who is into venture, which ultimately means risky, oftentimes early stage businesses. Now there's a spectrum to venture. There's early stage venture, there's later stage venture, which is considered pre-IPO transactions. But if you've invested in crypto and risky businesses your entire career, you're used to risk and you're very comfortable with that. You've made a lot of money, you've probably lost a lot of money in the process. Now, it's a totally different approach than somebody who comes from private equity. Private equity ultimately is a way for institutions to as well as private capital, which could mean asset managers, it could mean family offices, whether it's single or multifamily offices, but it's a way for them to take ownership in private companies. And whether they take minority stakes in these businesses or whether they take controlling stakes, these are private companies that are not directly influenced by the market swings as you have in public equities today. So when Peter says the market's up or down $2 billion, or there's been massive moves. Today the market is wonderful, and I wish there were more days and less uncertainty around the conflict overseas. But you don't have this mental uncertainty in private equity as you do in public equities, because you don't have these swings where today you're up big, tomorrow you're down big. And so investors could allocate their funds really depending on their, again, risk appetite and historical exposure to different asset classes. Now, it doesn't mean that a family office that historically has invested in private equity is going to stay only in private equity. Mm-hmm. They could touch private credit if yield and distributions are important to them. They could get exposure to real estate, either entirely on their own or through other GPs that give them access and what's called co-investment opportunities, where they can have exposure to venture. Now, those are kind of the main buckets. If you go down a layer or two, this is when things I'd say get a bit more interesting, and just like with anything else, as you peel another layer, there's another layer of complexity. It's kind of like starting a business. When you think you have a business to start, you're very, very happy and you're very excited about the prospect. But with every layer that you peel, oftentimes you're in for a sea of disappointment, because you start to understand that there's deeper potential issues and concerns that you haven't even thought of. And the same applies for investments. So I'll pause there. I know that was a mouthful, but
no, that was actually very useful and very. Thank you for the knowledge share. Now, we're in a time of inflation, and in one of the most recent consumer analysis my team had done, there were several topics that were at top of mind for the U.S. consumer. Inflation was one of them. Actually, the secondary one was tariffs. What is the almost inflation-proof investment that you would say is something, whether it's the wealthy or the regular consumer, should go for? And this is, by the way, not financial advice. I just want to mention. This is a conversation only for educational/entertainment purposes, but not advice.
Yeah, I think if the concern is around inflationary fears, as well as tariffs, it ultimately ripples down in any and every direction, right? There's really not a ton of isolation that you can think of that isn't affected, right? And you might think, well, if we're investing in real estate, how are increased interest rates going to affect our ability to buy assets and finance them? If you're investing in consumer businesses, well, where are you sourcing your raw materials and your ingredients? Are you importing them from overseas? And if you are, how much of your business is dependent on raw materials that are imported from overseas? I think there's probably only a handful of asset classes that are not necessarily going to be quote unquote disrupted by inflationary fears or recessionary fears or tariff fears. And I'd say one of those asset classes is probably sports. People
Tell
don't
me
necessarily,
more.
well, sports is quite interesting because 10 years ago or 20 years ago, the only way that you can participate in sports, and whether it's any of the emerging leagues or teams, or it's the big four, what you would call MLB, NBA, NHL, NFL. Now you have MLS, right? It's the big five. But 10, 20 years ago, the only way that you can participate in buying a piece of a sports team is if you were the wealthiest guy or gal in town. And that solves part of the issue. What it doesn't solve for is how do you actually exit? You had to find the next richest guy or gal in town. Today, sports investment landscape across sports has evolved significantly, where you're now starting to see, Ryan Reynolds is a great example where, granted, he's ultra successful and fairly wealthy, but he wasn't the only. He didn't acquire Drexel on his own. It was.
It's the soccer club.
It's the soccer club. That's right. And so when you think about sports as an asset class, there's a high degree of scarcity. And so if you think about what it takes to funnel down and identify a list of acquisition targets or investment opportunities for a traditional industry, whether it's tech, healthcare, consumer, you start with a funnel it's yay big. So you have 2,000 companies that you choose from. And then with every layer that you check the box and you either qualify or disqualify them, you end up with a much smaller audience of potential opportunities. With sports, you don't get that. You have 30. That's the only thing you're going to get. Typically, in every league, you have about 30 teams per league. Now, of those 30 teams, a portion of those teams are not for sale, and they will never be for sale. Now, when you think about when an asset actually trades, ultra wealthy people don't sell scarce assets. They usually keep them for as long as they can, and whenever they do sell them, it's generally for estate planning purposes. Now, even if you are able to buy into a sports team, that doesn't necessarily mean that you're going to be able to get out. And so this is where it gets deeper and deeper and deeper. Back to your question around what exists, what kind of opportunities exist that are not influenced by inflation or tariffs or recession. I am pretty sure that in the next 50 years, World Series is still going to happen. NBA Finals is still going to happen. The Super Bowl is still going to happen. Sports are eternal. I don't know if Microsoft will be around in the next 50 years. There may or may not be, but you can rest assured that people will continue spending time and money doing things that they enjoy. And as you now have this next evolution of infrastructure where you're not showing up to the Ball Stadium just to see a game. You now can come to a stadium that's more than a stadium, where you have infrastructure around the stadium where you can take your family for dinner, for drinks. You can go see Taylor Swift in concert whenever she's in town. And that incremental revenue also supports the overall case for sport investing, where You're not relying just on ticket sales. You're not relying just on merchandise. And as people have more discretionary income and, with today's rise of AI and frankly, uncertainty around, what the world is going to look like in the next 10 years. I mean, we're already starting to see it. Work weeks are now, in many places are not 5 days, it's 4 days. So what do people do with the fifth day? They go out and they spend their discretionary income on experiences. It's not about buying a trinket. It's about doing memorable things with people that you love and you want to be around. So I think sports is a very interesting asset class, again, for the reasons that I've outlined. And if you are able to gain access to a team that you grew up watching as a young boy or girl, and you can now make money in the process rather than just being a spectator if you have access to those opportunities.
How cool is that? So let's talk about data. I love talking about data. One of the premises and ideas when Peter and I started the show was that obviously consumers, which are Main Street, drive the outcomes on Wall Street. When you look at investments at MVV Partners, I'm sure that you have so many options, as you mentioned. There's hundreds, of opportunities in terms of what class of assets you could invest in and how. And you're working with millions of dollars here. How do you choose those investments, and what types of data do you base those decisions on?
It's a good question. Investors who are interested in exposure in specific deals, as opposed to being an LP in a 10-year fund, where you can now kind of handpick individual deals that you want to participate in. And this is what kind of leads me back to our original topic, which is, co-investments, one of the topics that we've covered earlier. It's an interesting way to deploy capital because as opposed to being in a blind pool fund where you really don't have any voice on the investments that are made by the general partner of the fund, you can now handpick individual deals that you actually care about. Now, if you're not in a specific fund and you're doing these deals on a deal-by-deal basis, you now can pick and choose what managers you actually want to partner with because you're not allocating X amount of dollars to a specific fund. You can work with that fund and you can say, look, we just met. We don't kiss on a first date. And so we're not comfortable getting married for the next 10 years, which is a typical length of a fund, of a private equity fund and a venture fund. And so what investors in today's environment, again, whether they're family offices or RIAs, are increasingly interested in exposure to specific managers, GPs, and specific deals where they could vet their track record, they can underwrite a specific deal that really resonates with them. So if you have an option to park your money with a fund that, let's say, is a generalist fund, perhaps they have expertise across 4 different sectors, you might say, look, I've made my money in consumer. I was a successful, food and bev operator, and I exited for $250 million. I'm very comfortable in the consumer space. I'm very comfortable in health and wellness, but perhaps I don't want to allocate to logistics. Perhaps I already have an extensive real estate portfolio, so I don't really want any more real estate. So what I want to do is handpick individual managers, individual deals, where you can also potentially negotiate fees. That is another topic. The old, 2 and 20 model, worked for many, many years. Today, 2 and 20 isn't necessarily the golden standard anymore. And as investors are increasingly getting exposure to individual co-investment opportunities where they're able to vet the manager and able to verify their track record, how much capital they've deployed, how quickly they've deployed it, how quickly they've returned the capital back, they're now able to have a lot more choices to pick from as opposed to just allocating to funds.
And when you do the due diligence, let's talk about it from the other side. So obviously for investors, they come with money. You're ready to go and invest, let's say $30 million in the coolest new club out there. Now, how do you vet? What's the vetting process and the due diligence process that you do for the other party? Because everything may look shiny on the outside with your investment and obviously where you're investing, but what's really the process looking like on the other side? Like, how do you find everything that you need in order to make the most informed investment?
In the instance of partnering with a fund, let's say on a co-investment transaction, right, which again, it's what we've seen is it's been a great way for individual investors to handpick individual deals. The very first thing that people tend to focus on is who sourced the deal. You may have found an opportunity to invest in, but does it mean you can properly underwrite it? And what have you done in the past? How much capital have you deployed to date? Where did that capital come from? How much of that capital have you been able to return? Because one thing is taking that money in, but people want their money back with a promised return. And so the very first kind of sweep of how to think about qualifying the opportunity is the company may be great, but it's about who is behind the deal and how capable are they? Are they hands-on investors? Everything is great when everything is great. What about when things go south? How have they fixed issues that weren't issues 6 months ago, but it's an issue now? That's the first thing that I say people are emphasizing. It's who are they partnering with? Once they're comfortable with the GP, they will obviously vet the deal. They will try to get an understanding of how long is that investment expected to be outstanding, which ultimately leads to their capital constraints because capital is not infinite. People oftentimes have a limited quantum that they can deploy today because part of their assets are already deployed elsewhere. And if you are an investor in, let's say, a fund, and your capital was not called up front, you have a capital call schedule, which means you have to write a check every 3 months, every 6 months. You could be an investor in a deal where you could have a deferred capital call schedule. So if you committed, just for simplicity, $3 million into a deal, you don't necessarily need to write a $3 million check at closing. You can write $1 million check now, $1 million check next year, $1 million check the following year. And if you're unable to manage your liquidity, you're going to be in a sea of trouble because you're going to miss on opportunities because your capital is going to be tied in elsewhere. And so if you don't have visibility into how long your investment is going to be outstanding, how quickly is that money going to be returned back to you? Is there going to be ongoing distribution, whether it's quarterly or biannual? And ultimately, what is the sponsor, the GP, whoever you're partnering with, what are they underwriting for the returns? Right? You need to understand what you're getting into, how long that money is going to be outstanding, what you can generate on that investment, which ultimately can help you manage your liquidity profile and your existing commitments.
Mm-hmm. And in terms of, I always think of money signals, right? And my question is more of, you invest so much money on behalf of clients. How do you understand the right money signal or the right signal for when you must exit or abort a deal? What are those things that you right away are like, this, I either must invest or I must run for the hills?
That is actually very prevalent in the world of venture capital is we need you to decide tomorrow and we need you to fund the next day. That is oftentimes, I wouldn't necessarily classify it as a red flag, but it's an issue that unless you come from the world of venture capital, it's a very foreign concept to you. And in many instances, whenever somebody rushes you to a decision, it ultimately oftentimes leads to a bad decision, right? Which is why many investors say, look, you need me to decide in 72 hours. That I can't do that unless you are intimately familiar with the business. I've had instances, many instances in the past where it's about getting in front of the right investor who again has the profile and the stomach for it, but what's normal for you may not be normal for me, and if you've made your money in VC and you're comfortable with these very fast moving targets, that's good for you. But I come from the world of private equity, and I don't invest based on revenue multiples in companies that are worth billions of dollars that have not turned a profit and have raised hundreds of millions of dollars. I'm in a totally different business where I buy family-owned businesses that are growing at 20, 25% a year, that are profitable, that haven't had a need to raise a ton of money. And again, there's a fairly distinct difference between the approaches of venture capital and private equity. So I think it's important for people to just understand who they are and what they're comfortable doing.
And from all the deals that you've done over these last several decades, is there one that was your favorite deal? What does the best deal look like in your world? Does it relate it to money and profits, or is there more to it?
It's kind of like sports, and I keep going back to sports. It's not all about offense, and it's not all about defense. It's not all about one player. It's oftentimes about a team, and there's a lot of dynamics that that are involved in a quality deal. While the upside can be meaningful and somebody can promise you the world where you can buy into the next pre-IPO transaction, there's risk associated with it. And so to answer your question, it's not all about the upside. It's oftentimes understanding what's the downside and what happens in a what if scenario, and are you covered? Which again leads back to, if you are partnering with a GP on a co-investment transaction or an independent sponsor, which we can go into, and I can provide some clarity around what that really means. But you're not checking one box, you're not checking three boxes, you're checking a lot of boxes to ultimately get to a conclusion and understanding whether you're comfortable with the investment or not. One of my favorite investments, a transaction that we supported or we were part of, was a client of ours that bought the largest parking garage operator in New York City. It was a wonderful experience because it kind of taught me the good and the bad. And the good of it was investors walked away making a very chunky return on their investment, and that investment returned capital back to them in less than 2 years. And so it's a wonderful outcome when you're expecting a multiple on your money and it doesn't take 5 to 7 years. It takes 2 years. The bad of it is people get used to the good life, and now they're asking, well, can you find me the next one that can give us a nice return multiple on our invested capital in a fairly short period of time? Now, this gets me to the next point. While on the surface, it sounds like it's a great outcome, there were investors in that deal that were not necessarily all that happy because they like to keep their money working for them for not 3 years, but 5 years and 7 years, which ultimately leads to, what is their return threshold? What are they expecting to generate? For some investors, they really like having quarterly distributions and having that, lunchbox money that, hits their account every quarter or every 6 months. And they say, great, thank you very much. Other investors say, look, I really couldn't care for IRR. I really couldn't care for any distributions. Keep my money for the next 5 years, but I need a 5X on my money. I'm not interested in 20% annual return on my investment.
Yeah.
Give me a multiple.
Wow.
So you really need to understand what does the person actually want? What goals do they want to hit? And if you can create these guardrails and understand who you're ultimately speaking to, what their goals are, what their challenges are, that will ultimately and hopefully lead you to do a better job in helping them identify that next investment opportunity that will check all their boxes. And they will be happy, not only because they're making money, but it's also because they're partnering with people who actually care about what they want, and they listen and ask questions. And most importantly, they don't waste time.
This has been such a fascinating conversation. Thank you so much for the opportunity. Thank you for coming on our podcast. Misha Vasilchikov.
Thank you very much for having me. It's been a pleasure, and I'm sure we'll meet again.
Yeah, absolutely. We will. Well, to all of our viewers and listeners, please do not forget to follow us, moneysignal.podcast, on all of the social media platforms, and our official website, moneysignalpodcast.com. It has been a true pleasure to talk to Misha today, and we'll see you guys soon.